So the intraday trend following strategy that I follow and talk about live in my streams throughout the day uses a very commonly used technical indicator. Now, in fact, I think it's the most commonly used technical indicator out there, and it's the simple moving average. Now, I don't use the moving averages for specific entries or exits. I purely use it for visualization. It helps me determine if a particular trend is in the market, whether it's trending up or whether it's trending down, or whether there's no trend at all, in which case the market is consolidating. Now, I know a lot of you understand moving averages. For those that don't, I just want to give you a brief explanation of how it is calculated. Now, a simple moving average takes the closing price of a currency pair, or indeed any other financial instrument, and averages out that price over a certain number of time periods. So for example, here we've got a chart. I've got some candlesticks on here at the moment. Okay, now each individual candlestick represents a period of time. Okay, so this could be a 15-minute chart. So each candle represents price action within that 15-minute period. At the end of 15 minutes, a new candle will start. At the end of that 15 minutes, a new candle will start. So on the changeover of each candle, the moving average calculates the closing price. So here, for example, market closed at 20, then we traded up for the next 15 minutes, then closed at 70, then up to 90, and then 30, 20, 15, and so forth. So the moving average is calculated by adding up all the closing prices over the look back period of, in this example, 10. We're looking back 10 candles. This is going to be a 10 period moving average. We add up all the prices. Okay, comes to 340. Clearly, I worked that out again before we came on cam. You divide that by 10. Okay, and you're going to get a moving average of 34. So currently the market is trading 40, or closed at 40, which is above its 10 moving average. It's 6 pips above its 10 moving average. Now, as a new candle is formed, the first candle in the cycle of 10 gets removed from the calculation. So we remove this 20. Okay, that comes off the calculation, and the new close goes into the calculation. So this could be up here back at 70 again. Okay, so we now add 70 into the calculation. Okay, so you add all that up together, we'll come to 390, divide that by 10, the moving average, MA, is now going to be 39. So you can see the moving average has moved from 34 to 39 as we've had a new, much higher close. Now, of course, this is going to go on and on and on as new candles open up, old ones drop off the calculation. This is a 10 period moving average. Now, a 10 period moving average is classified as quite a fast moving average. What do I mean by a fast moving average? Well, basically it means it moves pretty much with the price. Each individual candlestick close is quite relevant in the calculation because there's only 10 numbers in the calculation. If you're using a slow moving average, say like a 50 or 100 or 200, each individual close won't have too much of an effect on the actual moving average line. Let me explain. Okay, so here I put on a series of candles in an uptrending market. You can see we're making higher highs here all the time. This is clearly an uptrending market. We stall here, we consolidate, and then we move back down. Now on this chart, I've drawn in 3 moving averages. I've drawn in a fast, a medium, and a slow moving average. The fast moving average here is the blue line. This is going to be, say, for example, the 10 period moving average. It's going to track the price pretty closely. As you can see, it tracks the price pretty closely. As the market stalls, it stalls pretty quickly and turns back round in the direction of the price. Then you've got the slow moving average. Now this could be a 40, 50 or 100 moving average. I like to use the 10, 20 and 40. This would be my slow moving average, will be the 40. So it's a 40 period look back. So each individual close doesn't have as a big effect on the moving average line as, of course, the fast moving average. So consequently, the line will be smoother. It will react a lot slower to the price changes. And in the middle, we normally will have a 20 moving average. So this moves in between the 10 and the 20. Now, when I'm following trends, I like to be on the right side of these moving averages. I like to be, if I'm buying, I like to be above these moving averages. If I'm selling the market, I like to be on the below these moving averages. Now, as we turn around, I want my price to be below the moving averages. Now, when we get into the actual strategy, I'm going to show you exactly how we fit these in to the strategy itself, and all will become a lot clearer. It's a good idea if you're following trends to have an idea of where the trend is going, and using the moving average is a great tool for doing just that.